Welcome to the Week in Italian Startup, where we discuss the latest highlights happening in the Italian tech and investment ecosystem. Welcome everyone to the Week in Italian Startup. What's up, Nick?
Ciao, Jack. Good morning. Welcome everybody. Our things. It was a bumpy weekend, right?
Very bumpy weekend, which we're gonna try to dissect at best in our 20 plus minutes, which is impossible. I mean, this is something that we need way more, but we will try to uncover like a few things. So yeah, let's talk about the elephant in the room, about the liquidation of Silicon Valley Bank and how exactly that can affect the European and Italian ecosystem. So Nick, first of all, I have to say that the Italian press didn't do much a great job to explain properly what was going on, and I was pretty disappointed because of the macro titles kind of telling us how Silicon Valley overall is failing and the tech industry is over. So people listening, don't read the general press. Please go to analyst. Please go to the link that Nick submitted through the newsletter, explaining the situation in a deeper level. So that's the way to go, because the general press is just not doing. They're just pushing the urgency, making it sensational, which is not helpful for anybody. I don't know what's your thinking, but I was a bit disappointed, honestly.
Well, actually, I agree with you, but we're not new in this, that these things happen in terms of communication. So the press has to simplify for the general public, so it's easier to say, oh, the bank is out of money for whatever reasons, and the entire world is collapsing. That's partially true, but probably the reality is more nuanced. At the end of the day, from what it seems from all the commentators and all the descriptions of what's going on, it was a matter of don't being used to interest rates anymore. And allocating very wrong your let's say long-term assets as a bank, and that brought down basically an entire institution. The funny thing is that's that happens during the weekends is also the third bank that was basically put into forced liquidation, let's say so, by the US government. There was another one in New York of similar size as Silicon Valley Bank, and for similar reasons, even though it was not insolvent technically as Silicon Valley Bank was. So in a matter of a few days, in the US, 3 banks related to startups and crypto were basically forced to close and looked for government support. We also have to say that the American regulators moved swiftly, because just over a single weekend, they took the decision to insure basically 100% of the deposits of Silicon Valley Bank. So the companies that deposited money into the bank are probably almost surely gonna be made whole on their deposits. And shareholders and bondholders will probably see zero or close to zero investment into the bank.
Yeah.
And that's interesting, right? So I read about parallelism with what Lehman Brothers did, what happened with the latest bank crisis. So it's similar, but I have to say the US government moved quite fast in this case. Totally. They probably took the sensible decision. I mean, if they didn't tell the market that deposits were safe, probably we would have seen a lot more bank runs on the smaller regional local banks, even unrelated to crypto or to startups. Just because you never know. This is a small bank. Better get out quickly, because I'm under the impression that a lot of smaller banks are long on the wrong type of assets. So this is probably nothing that's only related to Silicon Valley Bank or the other two. So
yeah, the other element which I thought was interesting, and some people pointed it out, is that this is a bank run 2.0. So if before bank run really were people running to the bank to withdraw cash, this was a digital bank run. So imagine just the swiftness and how quick this can happen and escalate in a contagion effect all around Europe. So that's impressive and extremely powerful. So yeah, I agree with you. The reaction of the government was quick to reassure the markets and avoid contagion effect. So talking about contagion effect, let's see what can be the ripple effect in Europe, maybe, and in Italy. So a few people are saying that, everybody is safe, Basilea regulation is stricter, the banking sector is more protected and more regulated than the US. And especially in Italy, I think the CEO of Mediolanum Bank was telling how exactly in Italy doesn't really exist a bank of the sort of Silicon Valley Bank, just sort of holding cash for startups or working with startups. So there is less risk there, which is, we can agree about we can agree or disagree. We can discuss that, to be honest with you. I mean, I'm sure I don't have the same experience as this guy, but I've definitely a few arguments against that. But yeah, so
I wouldn't say that the systemic risk is in Italy it comes from startups. Let's remember that they raised like 2 billion euros last year. Like 2 billion, that's nothing for any bank. So it can't be a risk for anybody.
Good point.
Yeah, probably there's some other parts of the market that are at risk.
Yeah, I mean,
at our
I think,
latitudes.
Sort of saying there is no ripple effect, I think, is under-evaluating the problem. I think that founders are definitely being touched on a sensitive nerve and will start asking questions about their current backward hold funds and how exactly the insurance work. Because with a little bit of research, and I'm no expert on banking, is that according to especially in Italy, there is this Fondo Interbancario Tutela Depositi, FIDT, founded in 1987, is a consortium of 147 banks, basically kind of having insurance in case of liquidation or failure of banks. And basically, we have a way lower bar than US. So US is 250K, Italy is 100K. And the delta that is deposited is basically up to, the liquidation of the assets of the bank. So it's like when the bank is liquidated, your delta deposit will be assigned to liabilities of banks. And after the full liquidation takes place, then you're going to maybe return the capital. So,
and this is a funny thing, right? If you think about it, if everything is true, Silicon Valley Bank went under because they were marking to market all their bonds that were not marked to market. So they were basically saying, hey, if I have to sell off these bonds today, I'm insolvent.
Yeah,
it was probably more than this, but let's say so. No, I mean, you have 100 euros of bonds on your balance sheet, and they're saying, hey, I mean, if I had to sell it today, it would be worth 80, and 80 is less than whatever cash I owe to my depositors. And basically, in this case, you're doing the same. You're forcing a sale, so basically making it real that you are fully not able to repay back in full the deposits. So it's not just an accounting maneuver; it's reality. So when you put that into liquidation, you try to sell all these assets. That's real. You are not going to take your money back. So that's the magic of bank runs. They make an hypothesis real.
Yeah. So that's how you make basically when you feel the realized versus unrealized losses or gain. That's how you actually feel it, and it's not just an accounting thing. Good point. Yeah. Awesome.
Funny thing. The winner of the Nobel Prize in Economics this year, what was his, the reason for the Nobel Prize? What was the reason?
No.
A model of bank runs.
Awesome. Wow. That's...
So they described how bank runs work like a few months back. They won Nobel Prize a few months back for that modeling. So
that's crazy.
Beautiful. That's something beautiful.
Foreshadowing what was happening. Crazy. So I think there are a couple of takeaways here, but again, it's a discussion that can take hours. I think one is, maybe again, like founders being more thoughtful regarding banking and maybe steering toward like old school, like solid banks rather than maybe like sort of more new and digital only sort of kind of banks. So maybe there is a big bias that we're gonna be built after that, and that's probably like a different sensitivity of founders. I don't know how you feel about that.
I have to say, probably one of the things. I guess in the last few years, a very good treasury practice was lost. That was to have more than one bank account in more than one institution. So a lot of startups in the US in particular went under because they only had one account with one bank with all their money in it. But that's not that has not been true in all the history of companies. So good practices. Manage your money, diversify.
Back to the basics.
Back to the 80s, basically.
On the positive note, I was speaking with some wealth managers, and I was like, guys, there's a big opportunity here where you actually can build a product for liquidity sort of management to avoid the risk. So you can actually, once startups raise maybe like a few millions, then maybe they should consider buying like interesting product to actually manage liquidity differently than just deposits. So maybe there is an opportunity there where product. I don't know if they're gonna look like a more insurance product than treasury management product, but maybe there is something there on the wave of this kind of problem. Because again, 100K in the bank insured and the rest is out. That's crazy. I mean, if a founder raise his first Series A, 2 to 5 million, then big exposure for sure. And the bigger it becomes, the worse. So maybe there is something.
But I agree with you. At least when you have a certain amount of money, from a certain amount of money up, it may make sense. Makes sense to diversify your liquidity into something more, into some other product other than pure cash into a bank account. But that doesn't mean that you just go there and you start buying government bonds and whatever. So I mean that requires planning, because if you plan it wrong, you're basically in-housing the same thing that just happened in Silicon Valley Bank. You need cash. You have a bond. The bond lost value for some reason, and you're done.
That's a good point. Yeah.
So I agree with you, but it requires skill. So you need some kind of support and expert support in order to manage your cash.
All right. So let's move on just to cover the rest of what happened last week. So a lot of movement in the public market in Italy, especially in the Euronext growth in Milan. Starting from Cube, essentially. So let's talk about Cube for a second. So in general, let's talk about that. Cube Labs, health tech venture builder, is working on a listing on the Euronext Growth Milan, aiming for a pre-money valuation of about 30 million. So I was checking exactly the model, how exactly Cube Labs is working, and I must say it's like exceptional when it comes to kind of structure that they managed to build, so first of all, they have a portfolio, I think, of around 16 companies or so, roughly, and they're leveraging both grants, expertise, laboratories, and an angel network to actually push very technical companies in the health tech sector. So that's a very powerful model. And they're doing it. It seems like they're doing it extremely precisely and with a lot of detail. So it makes perfect sense for them to actually access these kind of capital markets. I mean, they very well organized for sure.
Yeah, I don't have much to add here. Of course, they operate in a market that's not mine. We are not new to see venture studios, accelerators, incubators that are going public, in Italy in particular. And this week we had another news related to similar operators, and we are going to tell more about it in a minute. I have to say that it is an interesting times in order to think to go public, in particular for this kind of company. But I mean, I think they're advisors, and they made a very thorough reasoning around the timing, around the opportunity to go public. So very nice, very good.
Awesome. Then the other big operation that happened, it is happening actually in the course of happening in the public market, is Digital Magics and the venture groups, basically working on a merger situation. So that's very powerful. So Digital Magic has been sort of helping the startup ecosystem for 20 years. L Venture then sort of took over from the Lewis University, and then started also investing in startups. And two big player, definitely in the seed space in Italy, pulling together to actually grow together. That's extremely powerful.
Yeah, this is another interesting operation. I mean, Alventure is very strong in the Rome area with a long tenure of accelerated startups. I think there are hundreds of startups in their past, and owning small participation, small tickets in a lot of them. And same for Digital Magics, but more present in Milan and Torino, I believe. So they're basically been considering and finding out how to become a global national player. I was taking a look at both are public. They're both public, and that's the interesting bit. And I was taking a look at how and whether the markets reacted to the news. And I have to say, Digital Magics looks mostly unmoved. So the share value, the share price is mostly there. There was some volatility in the last few days, but nothing extreme. While L Venture looks like so they had a positive reaction, not a big reaction, but it looks a bit kind of positive. So the market is waiting and looking, it seems. I mean, we're talking very low volumes here, but still
worth considering. Yeah, good point, Nick. Awesome. All right, talking about M&As, let's talk about Scalapay acquiring Cabel IP for an undisclosed amount. I know you did some research on that, so I'm super curious on what is your thought on the deal. What is the purpose of the acquisition? What do you think was the thinking behind this kind of acquisition?
So the purpose comes from the article. So Scalapay is aiming to become they want to be integrated into the payment service providers going to merchants, and probably, so I'm no expert here, so there are a lot of layers in the payment ecosystem. They need the license and the payment institution in order to be able to integrate with the PSPs. And they decided that rather than asking for the license and going through all the process to become a payment institution, just acquire one. So that's faster, easier, probably they have the cash to do it. And I took a look at the acquired company, so I didn't know about them. And there's a public website where they have a page with the governance. And looking at the shareholders, we see a lot of very small regional banks. Talking about banks and small banks in Italy, coming from Banco di Cambiano, Tuscan banks, Banca Pisa e Formacette, Banca Castagneto, very interesting, Banca Reale, so not only from Tuscany, but also from Lazio, from Piemonte. So they came together, created this consortium, and set up this payment institution that they all sold to Scalapay. And I took a look at one random bank from there. Banco di Cambiano, I would say. It was interesting. They have public financial statements, and from there we can see there are a few Cabel-related companies going around. And the interesting thing is that they had last June Cabel IP on their balance sheet at cost, like 45,000 euros, something like that. So I expect they posted some profits, some capital gain from the sale.
Awesome. So let's also talk about new entrants in the industry, just to on the closing note. So first of all, Exceptional Venture, founded by Paolo Pio, essentially is hosting a few events in Turin and Milan. And it's interesting because they already have like a 20 million fund, which is invested in about like 10 companies, 10-ish company. And they're focusing on essentially health and wellness sector and also food tech. So another player sort of trying to catch some of the biggest vertical that are happening in Italy. So that's very interesting.
Yeah, I mean, this is not an Italian fund. They are based in London, but Paolo is Italian, so it's very nice, very interesting that he's coming back and scouting on the locally, to find some targets. I think they've never invested in Italian companies, so that's a good signal that they're looking for some opportunities here. We'll see whether something good comes out of these meetings.
Awesome. And on a closing note, Azimut raising a third ALICrowd fund with a target of 40 million on the platform. So on Mamacrowd, they're actually open to receive investments through the platform. And essentially, ALICrowd III is a part of the LTIF that have been launched before. And is basically the platform for ALICrowd II also. And the goal is about 40 million euro, and the duration of the fund is going to be 8 years. And again, they're doing like some of the great job in Italy to actually democratizing venture investing by providing product retail. So that's powerful. I mean, as we continually say, the Azimut people are definitely on the edge of what's happening in the venture space. So awesome job to them for sure.
Can I make just a quick note here, because I find it interesting, right? Because it's basically that crowdfunding the specific Mamacrowd crowdfunding platform ecosystem and ALICrowd as a fund. So they're basically a small, tiny model of real world, right? So if you think in the real world, there are a lot of stocks, a lot of bonds, so you need to spend a lot of time in order to understand whether to allocate your capital. So what do? You go to Azimut and ask, hey, Azimut, can I invest just in the mutual funds? And you can pick and decide where to allocate capital on my behalf. And you pay a fee, and Azimut will allocate the capital for you. That is kind of the same, right?
Yeah.
Because ALICrowd is gonna invest in companies that are raising capital on the crowdfunding platform that you could invest by yourself.
Yeah.
Or you don't have time, you think you don't have the competence to select the right targets, you need to follow, you need to handle your portfolio together. So in that small ecosystem, you decide, instead of spending time picking my investments on a single platform, they are all there. They are all there for you, so easy to pick. I just give money to Azimut, I will pay a fee for it, and they will do that job for me.
That's right? It's definitely making the ecosystem more fluid. I mean, a professional operator taking over and allocating liquidity. So actually, even people that have no time or competence, but they want exposure, they can actually access. So that's powerful. I like the model. And the good thing is that this is something that only professional investor and accredited investor, depending on the kind of definition, would have access to. But now is very open. So the minimum ticket is 10K. And again, this is not financial advice. It's a high risk investment, and the capital is locked in for about 8 years. But the structure is definitely something that is bringing venture investing closer to retail, which is like a definitely positive way to think about it. Yeah, completely. All right, Nick, thank you so much for joining, and I'll see you next week.
Ciao, Jack. Ciao, everybody. See you in a week.